On November 6th, 2025, something extraordinary happened that Wall Street doesn't want you to notice. Warren Buffett's Berkshire Hathaway revealed a cash position of $381.7 billion, the largest cash reserve in the company's history. That's more than Apple, Microsoft, Amazon, and Alphabet's cash reserves combined. But here's what's terrifying. For the 12th consecutive quarter, Buffett has been a net seller of stocks, his longest selling streak in decades. While the S&P 500 hovers near all-time highs, the man they call the Oracle of Omaha is sitting on enough cash to give every American $1,500, and he's not alone. In the next 12 minutes, I'm going to show you the 3 data points that billionaires are watching right now, data points that suggest something catastrophic could happen in 2026. This isn't conspiracy theory. This is publicly available information that everyone can see, but few are connecting the dots. First, let's talk about what Warren Buffett himself calls the best single measure of where valuations stand at any given moment, the Buffett Indicator. The Buffett Indicator currently sits at 219%, an all-time high. This measures the total stock market value divided by GDP. In plain English, the stock market is worth more than twice the size of the entire U.S. economy. When this indicator approached 200% in 1999, the dot-com bubble burst. It approached 200% again in late 2021, and within months, the S&P 500 fell more than 25%. Now it's at 219%. The Shiller-Cape ratio, another historically accurate predictor, tells the same story. This ratio is now at its second highest level ever, trailing only the peak right before the dot-com crash in 2000. Look at the pattern. 1929 spike led to market crash. 2000 all-time high led to dot-com crash with 78% Nasdaq decline. 2021 peak led to 25% decline in 2022. And now 2025 shows the second highest reading ever. The top 10 companies in the S&P 500 now make up almost 40% of the entire market value, higher than during the late 1990s dot-com boom. When this much market weight depends on just a few companies, the market becomes extremely fragile. And here's the kicker. The S&P 500's current earnings yield is around 3.2%, while 3-month Treasury bills are yielding close to 4%. Translation, you're getting paid more to hold cash than to own stocks. Now, you might be thinking maybe Buffett is just old and too cautious. Let me show you what the major institutions are saying. JP Morgan Global Research just released their 2026 market outlook, and they're forecasting a 35% probability of a U.S. and global recession in 2026. That's more than 1 in 3 chance of a recession. Think about that. These aren't random internet analysts. This is JP Morgan, one of the largest banks in the world, telling their clients there's a 35% chance of economic catastrophe. But here's what they buried in the report. After unwinding pandemic supply shocks, inflation has hovered around 3% with little sign of moving lower. They expect elevated goods price pressures to remain in place through at least the first half of 2026. Moody's Analytics puts the risk of a 2026 recession at about 42%. Mark Zandi, their chief economist, said, "I think we'll most likely get through 2026 without a downturn, but nothing else can go wrong. Like nothing. We're pretty much on the edge." 64 economists surveyed by the Wall Street Journal put the odds of a recession in the next 12 months at 45%, up from 22% in January 2025. Almost every major financial institution is saying the same thing. We're walking on a razor's edge. ADP data showed job losses in 4 out of the last 6 months. That's consistent with a recession. Meanwhile, layoffs are up 54% year over year. When job losses accelerate while the stock market sits at all-time highs, history tells us what comes next. Now here's where it gets interesting, and where smart money is positioning for what's coming. While everyone's watching stocks, there's a supply crisis unfolding in physical assets that could explode in value during the next downturn. On December 18th, 2025, silver surged above $66 per ounce, hitting fresh all-time highs. That's up more than 120% year to date. But why? 3 factors are colliding. First, strong underlying fundamentals from the rapidly expanding solar, electric vehicle, and data center sectors are driving unprecedented industrial demand. Let me give you a number that will shock you. Global electricity consumption from data centers is projected to double to around 945 terawatt hours by 2030. That's roughly equivalent to Japan's entire electricity consumption. Every AI server, every data center, every solar panel requires silver. Goldman Sachs forecasts global power demand from data centers will increase 50% by 2027 and potentially 165% by 2030. Second, we're facing a supply crisis. Global visible silver stocks in 2025 can only cover 1.2 months of world consumption, far below the safe boundary of 3 to 6 months. Silver stocks in London have dropped below 4,000 tons, accounting for less than 10% of global demand. China's silver stocks have dropped to 715 tons, the lowest level in 7 years. The coverage rate of COMEX silver warehouse orders in the United States has plummeted to 23%. Translation: there's not enough physical silver to cover the paper contracts. Third, the Federal Reserve is pivoting. Fed Governor Christopher Waller, a leading contender for the Fed chair role, said U.S. borrowing costs should be up to 1 percentage point lower, warning that job growth has slowed to near zero. When interest rates fall, precious metals historically soar. UBS has raised the target price of silver in 2026 to $58.60 per ounce, with a possibility of touching $65 per ounce. Citibank and Standard Chartered predict silver will stabilize above $55 per ounce from Q4 2025 to Q1 2026. So why is all this happening now? Let me connect the dots. Markets are at bubble-like levels by every historical measure. The smartest investors in history are hoarding cash. Major banks are warning of 35-45% recession odds. Real assets like silver are in supply crisis. And we're seeing a structural shift requiring massive industrial metal consumption for AI energy demand. Buffett didn't just randomly decide to sell stocks. In the late 1990s, he built up cash before the dot-com crash. In 2007, his cash pile quietly climbed before the global financial crisis. In 2021, his cash allocation was near record highs just before the market peaked and declined 20%. He's done this 3 times. And he's doing it again now, except this time, his cash position is larger than ever before. Why is January 1st, 2026 significant? The new tax year begins creating potential selling pressure. Q1 2026 earnings reports will show the real economic damage. JP, Morgan expects consumption downshifting in Q4 2025 with potential recession emerging in 2026. And Federal Reserve policy decisions in early 2026 will be critical. The smart money isn't waiting to see what happens. They're positioning now. I'm not a financial advisor, and this is not financial advice, but I can share what the data tells us about how sophisticated investors think about risk management. The Billionaire playbook shows us several key principles. First, cash is a position. Buffett is holding $381.7 billion in cash, roughly 31% of Berkshire's portfolio. Cash gives you optionality when others are forced to sell. Second, quality over quantity matters. Northern Trust Asset Management recommends exposure to quality and value stocks, as well as low volatility factors for 2026. Third, physical assets perform during uncertainty. History shows precious metals outperform during financial crises. During the 2008 crisis, gold rose 25% while the S&P fell 37%. During the 2020 pandemic, silver surged 47% in 6 months, and currently, silver is already up 120% in 2025. Fourth, diversification across asset classes is critical. Investment managers recommend maintaining diversified portfolios that include at least fixed income, particularly high-quality treasuries, as effective risk mitigation. What you can research includes studying valuation metrics like the Buffett Indicator, Shiller-Cape, and PE ratios, monitoring recession indicators such as yield curve, unemployment, and manufacturing PMI, understanding supply and demand dynamics in physical assets, learning about portfolio construction and risk management, and researching historical market cycles and patterns. The key principle is this: sophisticated investors don't try to time the market perfectly. They manage risk. When risk is high like now, they reduce exposure. When panic hits and valuations normalize, they deploy capital aggressively. Here's my question for you. Do you think Warren Buffett knows something that average investors don't? Or is his $381 billion cash position just coincidence? Drop your answer in the comments below. And here's a follow-up question. If major banks are forecasting a 35 and 45% chance of recession in 2026, what percentage of your portfolio would you hold in cash or defensive assets? I want to hear from you. Are you positioning defensively, or do you think this bull market has more room to run? 3 things to do right now. Subscribe to this channel for data-driven financial analysis. Share this video with someone who needs to see this information. And comment below with your 2026 market prediction. Remember, the goal isn't to predict the future perfectly. The goal is to understand risk, position accordingly, and protect what you've worked hard to build. One final data point. According to options market pricing, the current probability of a 30% or greater stock market decline over the next year is approximately 4%. But remember, markets rarely predict black swan events. The 2008 crash, the 2020 pandemic crash, and the 2022 bear market were all low probability events until they weren't. The smart money is preparing. The question is, are you? Sources: Berkshire Hathaway Q3. 2025 earnings report, JP Morgan Global Research. 2026 Market Outlook, Goldman Sachs 2026 Portfolio Research, Moody's Analytics Recession Forecasts, Wall Street Journal Economist Survey, UBS and Citibank silver forecasts, trading economics, silver price data, International Energy Agency, data center reports, Northern Trust Asset Management 2026 Outlook. All data points are publicly verifiable and current as of December 2025.